Welcome back to Smart Simple Savings, and today we are talking about free money. Are you missing out on free money? Are you a full-time employee that has access to a retirement account? If you work for a public company, that's a 401k. If you work for a nonprofit, that's a 403b. If you work for a state or federal government, that's a 457. And all that is the tax code numbers, they were not creative. So the 401k is tax code 401-K. You can guess where 403b comes from. But what this is a retirement option from your employer that allows you to contribute pre-tax dollars to a retirement account. And almost all of these are going to offer the employer where they will contribute up to a certain percentage. So a lot of them will contribute half of what you do at 50%, up to a certain percentage, whether that's 4 or 6%. Some will match dollar for dollar up to 4, 6%, and sometimes even more. But that's about the average. But that allows you to do pre-tax dollars, which also reduces your tax liability because it lowers the amount of taxes or the income that you're reporting on your taxes. But if you're not going up to that company match, you're missing out on free money. Please don't make the mistake I did when I first started my career. I wasn't living under a budget. I wasn't living beneath my means. And when I looked at my retirement, I was in my early 20s and I saw retirement so far away, I didn't see it as a priority. And so there was times I was contributing 1% and my employer was contributing 0.5%, and I was missing out on 4 to 5% more of my income as free money going into my retirement account that could have had 30 years or 40 years of compounding that I missed out on. And I did that for 5 or 10 years. They do have limitations where you can't draw the money until you're at retirement age without paying a penalty. So this is a long-term investment. So for 2023, the government has increased the contribution limits to the 401k, 457, and 403b from $20,500 to $22,500. So you can contribute $2,000 more this year for next year than you did this year. And for the IRA and the Roth IRA, the contribution limit has gone up from $6,000 to $6,500. And they still have the catch-up, but they didn't increase the catch-up. So if you are over 50 and you want to contribute to your IRA, you can contribute $7,500 over $6,500. They also increased the limits on whether your IRA contribution is tax deductible for 2023. But I'll link that IRS page in the description. We're not going to dig into all those, but they did increase the salary limits on the deductibility of those contributions. Now, I want the meat of this video to be you understanding how you should prioritize your retirement contributions, and then also understanding what that is being invested into. So let's go over the prioritization first. You need to, if at the least, maximize your contribution up to that company match. So whatever it is, you want to maximize the free money you're getting from your employer. Now, once you've done that, you need to stop and go, and if you haven't already, create a Roth IRA and contribute to that, because that is post-tax dollars, and that is able to be withdrawn and grow tax-free. So prioritize going up to the company match where you get that free money from your employer, and then you're going to a Roth IRA. And we just talked about that contribution limit going up from $6,000 to $6,500, and if you're over 50, you can go to $7,500. Now, if you can maximize that match and max out that Roth IRA, if you're married, you can have one for you and one for your spouse. Maximize those out. Then go back to your 401k or your 403b or 457 and contribute to it up to that max that we talked about earlier. Now, if you do have the ability to max that as well, then you can go into a regular brokerage. But the other thing I want to make sure you understand is once you put the money into those accounts, understand what it's invested into. So your 401k and your 403bs are going to go primarily into mutual funds. So this is a large group of multiple companies, very similar to an ETF. And so, but you need to understand what those are, what those historical return is, what makes up the top companies in those accounts, so you can have an idea of the potential going for the future. There are some in there that are heavy in bonds or different markets that may not have a good future for the next 5 to 10 years. So make sure you have a basic understanding of what your money is going into. And if you don't, there are time-dated funds that are based off your estimated retirement age that you can put the money into. And those are very conservative, and they'll go into more and more bonds as you get closer to retirement. But have someone to help you understand some of these mutual funds and maybe even help you pick out 2 or 3 to diversify into. Now with the Roth IRA, you have a much broader option. So for 99% of people, I would say invest in the S&P 500, find a broad market ETF, pick 2 or 3, invest in those. Unless you want to spend the time digging into and understanding companies, then you can pick individual stocks. But for the vast majority of people, it's pick 1 or 2 mutual funds in your 401k. If you have a Roth, 2 or 3 different ETFs that cover a broad range of the entire market, and stick with those, set it and forget it. So as soon as you have the ability to maximize that match, you need to do it. The way compounding works is going to grow that so much. And if you know someone that is starting out, please share this video with them and let them know that that is one of the most important things they can do in the early 20s. But please make sure, if you don't understand it, have someone help you understand how to use the site that manages your 401k, so you can get the best return for that dollar that you're going to get. So if you get like a 3, 5, maybe even 10% raise coming in the next year, let 70% or more of that go into your retirement, and then let the rest of it come into your paycheck. But you've been living on that current salary. Continue to do that and let your retirement contributions increase. Thanks for watching, guys. I hope this was helpful. Again, make sure you're hitting that company match, and then you know what your money is being invested into, so we can continue to be smart, simple savers. See you on the next one.